Welcome to this explainer. Today, we're exploring the absolute highest stakes operation in finance, the financial close process. If you've ever wondered why the accounting department basically survives on cold pizza and black coffee at the end of every month, well, this is why. Every single month, quarter, and year, finance teams globally kick off this massive, highly coordinated symphony to finalize their numbers. The pressure is honestly immense. But why? Why does this routine bookkeeping exercise need Pentagon-level security? Because it's not just bookkeeping, it's a fortress. It is the primary fortress defending a company's entire financial integrity. So, what actually happens when the corporate books don't balance? It's a high-stakes question, right? Because failing to balance the books throws the door wide open to devastating misstatements and auditor qualifications. When numbers don't tie out, or when your controls fail, it's not just a minor headache for the accounting team. No way. We're talking about undetected fraud, aggressive earnings management, and some serious regulatory fallout under US GAAP. And the close process, that is the exact point of maximum risk for these kinds of catastrophic failures. To really understand how to protect this financial integrity, we're going to build a fortress today by looking at four things. First, the close cycle cast. Second, internal controls and defenses. Third, the risk register. And finally, measuring success with KPIs. All right, let's jump straight into Section 1, the close cycle cast. Notice the dynamic at the executive level here. The controller owns the calendar and coordinates the entire orchestra, while the CFO gives the ultimate sign-off before anything goes public. Think of the controller as the director on the ground. They're tracking statuses, reviewing manual journal entries, and making absolutely sure no period locks until every single reconciliation is signed, sealed, and delivered. The CFO, on the other hand, is your final line of defense. They review the board packages, approve those high-level topside entries, and sign that crucial leadership certification. Now, what's genuinely fascinating here is seeing how every single department owns a highly specific slice of the close. You've got revenue accounting handling cutoffs, you've got accounts payable and expense hunting down uninvoiced receipts. Cost accounting is dialing in inventory reserves, while treasury is marking investments to market. It's a massive delegation of duty, and the close literally cannot finish until every one of these cycle owners completes their specific piece of the puzzle. But here's the absolute non-negotiable point. The close cannot proceed to financial statement prep until the subledger owners reconcile their ledger to the general ledger. I know, it sounds basic, but this is the bedrock of financial integrity. If the accounts payable subledger doesn't perfectly tie out to the GL, boom, the whole process stops dead in its tracks. Once the basic ledgers are locked, a second wave steps in. We've got the consolidation, analysis, and assurance teams. Intercompany eliminates balances so the consolidated trial balance actually makes sense. FP&A dives into variance analysis to explain the why behind the numbers. Tax does their provisions, legal reviews contingencies, and hovering over the whole shebang are the internal and external auditors, sampling reconciliations and hunting for any red flags. Okay, moving on to Section 2, internal controls and defenses. These two requirements right here, these are essentially the corporate commandments. Skipping them is your fastest route to undetected fraud. Number 1, you have to separate journal entry preparation from approval. And number 2, the reconciliation function must be independent. If the exact same person preparing a journal entry is also approving it, well, your fortress just left the front gate wide open. You always need a second, independent set of eyes on the money. So, how do we defend the fortress? We use 2 layers, preventative controls and detective controls. The difference is vital. Preventative controls stop an error before it ever happens. Think of them like your locks and security guards. Detective controls, on the other hand, catch whatever slips through the cracks. They're your security cameras and alarms. And trust me, during a chaotic close, you absolutely need both. Let's look at how a preventative defense actually builds step by step. It starts before the close even begins, establishing a strict calendar with named owners. Next, you sequence the subledger lockdowns. Then you mandate independent approvals for manual entries. And finally, the ERP system itself is physically restricted. No period locks without a verified controller sign-off. Period. Now, on the detective side, a well-controlled close relies heavily on automated escalations and rigorous analysis. This is where teams do flux analysis, basically checking variances between actuals, budgets, and prior periods to see what looks weird. They're looking for massive round numbers or, entries mysteriously posted at 2 a.m. Auditors absolutely love hunting for those 2 a.m. entries, by the way. These detective controls are actively sweeping for mistakes. All right, time to look at the dark side. Section 3, the risk register. Meet the ultimate villain of the close process, management override. This happens when top-side entries, those high-level adjustments made directly by management, completely bypass controls. It is terrifying because it comes from the top. If a CFO or controller can just post unchecked manual entries, they bypass every single defense we just built. It's exactly how massive fraudulent misstatements happen. It's literally the guardians of the fortress opening the gates from the inside. This rogues gallery of high-impact risks shows how things fall apart. Recognizing revenue in the wrong period because the sales team got a little too aggressive, that overstates your current revenue. Missing an accounts payable invoice for a huge legal fee, that understates your expenses, making your income look artificially amazing. Or intercompany accounts that are totally out of balance, that just fundamentally breaks your consolidated reporting. And it doesn't stop there. If you ignore subledger to GL differences or skip over undisclosed estimate changes, you're asking for trouble. Say management underestimates a probable legal contingency, you end up directly overstating income. Even something as simple as delaying a going concern assessment until the end of the year instead of checking it every period can completely derail your audit. But here is the absolutely crucial takeaway. These risks aren't just random accidents. Almost every single risk traces directly back to a specific control that wasn't followed. A missed independent review, a totally rushed sign-off. That is exactly what breathes life into the risks on our register. When the defense wall fails, the risks get in. Let's move to our final section, Section 4, Measuring Success with KPIs. Fun fact for you, 7 business days. That is the target cycle time from period end to issuing management accounts. It's the absolute gold standard for velocity. Because look, getting the numbers out fast is crucial for business agility. If it takes your team 20 days to close, that data is completely stale before the CEO even looks at it. But, and this is a huge but, speed has to be balanced with compliance. You can't just be fast, you have to be controlled. World-class teams are tracking both. They look at close cycle time, sure, but they also track manual journal entry approval compliance. They're literally verifying, did this manual entry actually get an independent signature? They measure exactly how many of those flux variances have real written explanations. At the exact same time, we measure quality and risk. Quality means checking your accrual accuracy rate. When the real invoices finally show up, do they actually match what you accrued? Risk metrics track things like the magnitude of audit adjustments. You have to keep a close eye on your uncorrected misstatements to make absolutely sure they don't snowball and cross your materiality threshold, which would totally mislead an investor. I love this breakdown because it perfectly illustrates that world-class finance teams give equal weight, 25% each, to all 4 pillars: velocity, compliance, quality, and risk. It creates a complete 360-degree view of the close cycle. If you over-index on just one of these, well, the entire fortress starts to lean. Because the truth is, no single KPI tells the whole story. You literally cannot judge a close cycle's health by just looking at velocity. If your team is bragging about a lightning-fast 5-day close, but your accruals are wildly inaccurate and your subledgers don't tie out, actually, scratch that. You haven't closed the books at all. You've just rapidly generated a pile of highly risky, unverified numbers. So I want to leave you with this question to evaluate your own company's fortress. Is your close genuinely controlled, or is it just fast? Are you actually enforcing independent reviews or just rushing to meet a deadline? Think about it. Thanks so much for joining me for this explainer, and I'll catch you next time.